Welcome back everyone to another ICT explained video, and in this video I will be talking about implied fair value gaps. So let's not waste any more time and begin. Alright, so just a very quick introduction to the implied fair value gap. So this is a specialized advanced price action concept introduced by ICT himself in the 2023 mentorship program. I believe he also talks about it on the 2024 or 2025 mentorship program, but don't just take my word for it, you can look for it yourself. It represents a hidden type of imbalance in price action that differs significantly from traditional fair value gaps. Unlike conventional price gaps that are visually obvious on charts, implied fair value gaps require specific identification techniques and understanding of market structure. Now, ladies and gents, do you need to know this type of, tool or concept to be profitable in the markets? And no, this is just something that you guys can learn and also add to your toolbox if you want to. You don't have to. This is just if you want to, okay? Don't feel like you must know this, all right? So if you're thinking that by watching this, you're gonna become profitable just by understanding this concept, I promise you this is not the holy grail you're looking for, okay? If anything, just look at my beginners playlist. You'll find everything you need in there. All right, let's move on. Now, let's talk about some key characteristics of the implied fair value gap versus the traditional fair value gap. So on the traditional fair value gap, when it comes to visibility, there's a very clear visual gap between the candles, as you already know. But with the implied fair value gap, there is no visible gap on the chart. All right. For the formation, a direct gap between the candle bodies is obvious. But for the implied fair value gap, you need a 3-candle pattern with overlapping wicks. And I'll explain this in a second. When it comes to identification, it's easily visible to all traders when it comes to the regular or traditional fair value gap. For the implied fair value gap, this requires specific technique to identify. Now, when it comes to the middle candle, it can be any size for the traditional fair value gap. But for the implied fair value gap, you have to have a large body with substantial range. Now, you don't need to have like a bunch of market structure, but it's recommended, all right? It's recommended, but really just a large body with big candle wicks on each side, that's more than enough. But now, when it comes to the measurement, just a direct gap measurement, all right? When you see a regular fair value gap, you don't need to measure anything else, just wick to wick, right? For the implied fair value gap, you use consequent encroachment, which is just the 50% levels of your fib. Now, here, as you see, I have a traditional fair value gap marked up, right? Clear visual gap between candles makes identification straightforward. Price typically returns to fill this gap in future trading. But what do we have here with the implied fair value gap? There is no visible gap due to overlapping wicks. Implied fair value gap is defined by the 50% levels or consequent encroachment of the overlapping wicks, creating a hidden imbalance. So what do I mean by that? As you can see here, I drew my fib from the top of this wick here, or the bottom of the body of this bearish candle, to the bottom of the wick. That gave me 50% here, right? 50% of that wick. And then I go here to this wick, same thing, but except I draw from the top of the body and the top all the way to the top of its wick here. That gives me the 50% of that, right? So what we want to use is 50%, only the 50% areas to mark up or shade in, right? And as you can see in this example here, I got it shaded in with an indicator, which I will share down in the description below. The indicator will mark it up easily for you. But that is how you would do it manually. 50% here and then 50% from here. And you only use that 50% to make or mark up your fair value gap, right? Pretty easy, pretty simple once you start getting the hang of it, okay? Now, implied fair value gaps represent hidden market inefficiencies that are not apparent to most retail traders, but are recognized by institutional algorithms. It's really interesting. I honestly don't think that you guys absolutely need to learn this, in my opinion, but it is a pretty interesting concept So if you want to learn more, stay tuned, like and subscribe guys, and leave your comments down below if you have any questions on any of these slides, okay? Alright, so let's talk about formation and identification techniques. So implied fair value gaps forms during displacement moves with large bodied candles, where the wicks of adjacent candles overlap, creating no visual fair value gap. So what's the identification process? So number one, you locate a large range candle that stands out from the surrounding price action. All right, key words here: surrounding price action. Number two, confirm the absence of a conventional fair value gap. So you don't see a fair value gap basically. Number three, identify overlapping wicks on both sides of the large candle. All right, it has to be a fairly large candle. Number four, find the consequent encroachment, which is the 50% level, of each overlapping wick. Number five, mark the space between these 50% levels as the implied fair value gap zone. Now, important note, unlike conventional price gaps, implied fair value gaps require precision in identifying the consequent encroachment levels. This hidden structure is not visible to the untrained eye, but provides significant trading opportunities. Now here I have an example. I basically marked up the same example, but I changed the levels to make them like a little more easier to identify. Why? Because the 50% areas are what you want, okay? The middle candle has a large body with substantial range, right? Wicks of first and third candles overlap the middle candle. So this wick here and this wick here, it clearly overlaps. And then an implied fair value gap zone is between the 50% levels of the overlapping wicks, which are these levels right here, right? It's really simple, guys. It's not too difficult. Just make sure you practice, and like I said, I'll leave a link to an indicator that'll mark them up for you automatically. All right, now let's talk about trading applications and market inefficiencies. So hidden support and resistance. Implied fair value gaps function as invisible zones where price is likely to react, providing high probability trading opportunities that most traders cannot see. Now, directional bias. Implied fair value gaps act as support, or bullish implied fair value gaps, or resistance, bearish implied fair value gaps, depending on their formation direction, helping traders anticipate behavior. So if you're on a higher time frame and you're trying to use this for your bias, and you see an implied fair value gap on a bullish market structure, then price is probably going to be bullish for the rest of the day or the rest of the upcoming week. Just an example. Entry and exit points. When price retraces to implied fair value gap levels, these zones offer optimal entry points for trades and strategic exits when price approaches from the opposite direction. So you guys can either use implied fair value gaps for entry points, or you can target implied fair value gaps. It's up to you. And I've even seen some people use implied fair value gaps to place your stop losses at, right? And now, institutional inefficiencies. These zones represent areas where institutional money has created market inefficiencies that retail traders cannot easily identify without specialized knowledge. But thanks to ICT, we now know this. Market balance mechanism. Even without visible gaps, market algorithms use these hidden imbalances to reprice and balance price delivery, creating predictable reactions. Lastly, practical application. Monitor price approach to implied fair value gap zones for potential reversals or continuation moves. Use these levels to set stop loss orders or profit targets beyond retail trader visibility. Alright, so relationship to consequent encroachment. In implied fair value gap identification, consequent encroachment becomes crucial for defining the exact boundaries of hidden imbalances. So for precision method, this requires more accuracy than looking for obvious fair value gaps. Boundary definition, used to mark the upper and lower limits of the implied fair value gap. Algorithmic significance, the levels where algorithms detect and respond to hidden imbalances. Now, price reaction, when price approaches but fails to reach a consequent encroachment level, it often signals strength or weakness. This is a quote from the video, and that video I also have the image here. So ICT is saying the fact that it failed to get to that level when it's likely to go for sell side, it's showing you it's exceedingly weak. I am not tripped up by the wicks. So here in this image, you see price was trying to reach the liquidity up here, but it failed to pass the consequent encroachment or the 50% level of this fair value gap, right? The implied fair value gap, meaning that price is weak going towards the upside because price is in reality bearish. There's more bearish selling power than there is buying power to reach that liquidity. Okay, hopefully that makes sense to you guys. And don't worry about the wicks smacking a little bit over the fair value gap or any sort of point of interest that you're using. ICT describes that as mohawking. All right, it's just price being a little bit extra. You know, the price is just doing a little too much. It's going above and beyond what it's required. Okay, just to put it as simple as I can. Now, key concept. The consequent encroachment method allows traders to identify hidden imbalances that most technical analysts miss. The trading edge. By understanding how algorithms detect these zones, traders can anticipate price reactions before they occur. Advanced application. When price fails to reach a consequent encroachment level, this often indicates a stronger commitment to the current direction. Meaning if it's bearish, if the trend is bearish, it's definitely going to be bearish with even more accuracy because it failed to pass completely through the consequent encroachment level. All right. Now, trading psychology, mistakes, and key takeaways. Some common traps to avoid. Wicks distraction. Don't be tripped up by the candlestick wicks. Focus on the bodies and consequent encroachment levels. Next, visible gaps only. Most traders only look for obvious visual gaps like fair value gaps, missing hidden imbalances like the implied fair value gap. Next, poor stop placement. Placing stops immediately behind recent highs/lows make you vulnerable during high resistance liquidity runs. Next is market structure confusion. Mistaking short-term liquidity runs for genuine shifts in market structure. Now, competitive edge, institutional vision. See what retail traders can't. Hidden inefficiencies where smart money operates. Algorithm and alignment. Traded harmony with the market algorithms that reference these hidden levels. Now some key takeaways. Implied fair value gap identification. The 3-candle pattern with large middle candle. Overlapping wicks with no visual gap. Consequent encroachment. The 50% level of overlapping wicks defines implied fair value gap boundaries. Price reaction. What price does not do is often more important than what it does. Failure to reach consequent encroachment levels often indicates a strong commitment to the current trend direction. Now, bodies versus wicks. Candle bodies tell the true story. Wicks show where the damage occurs, but can be misleading. So like I said, guys, just because wicks are able to pass through any point of interest, including fair value gaps, doesn't actually mean that price is going to head towards the opposite direction of what the current trend was going in, right? Sometimes it's just a way to fake people out. Sometimes it's just to grab some liquidity. Maybe someone placed their stop loss over that fair value gap and the wicks are just trying to take that liquidity, right? Little things like that. Action items. Review your charts, identify implied fair value gaps in your previous trades, right? Practice locating consequent encroachment levels on any chart, and then develop a tracking system for both visible and implied fair value gaps. These are things that you guys can do right now. If you want, you can open up a chart and try practicing. Now, what I'm going to do is show you a couple of examples on the charts on how you can apply this concept. Alright guys, so we are going to be using copper for this example, and if you haven't traded with copper, I highly suggest you try it out. Copper has been pretty good pair to trade with. So we're going to use order blocks and kill zones to trade with implied fair value gaps. Now here I'm using the indicator for this example. Now if you guys want, you can use my strategy that I have in my Discord for my supply and demand strategy. Now, what do we see here? For this example, I will mark up this order block and we will simply use this order block as part of our sweep of liquidity. So this order block got slightly swept, right? Now I'm trying to also use the mohawking example, or just an example of what mohawking would look like, right? Because the ICT, like I said, does talk about this So this is basically what mohawking is, right? You have a point of interest, price comes down, sort of sweeps it a little bit, right? It doesn't actually break through it, and it doesn't even break through, sometimes it doesn't break through the 50% or the consequent encroachment of that point of interest, like in this case, this order block, right? But it did sweep some liquidity. So it swept that liquidity, still price held above the 50% level of that order block. We're trading in the New York kill zone. This is from 7 a.m. all the way up till 10 or 10:45. It's because I'm using the 15 minutes, so it's a little different. But yeah, here's 10 a.m. right? And you can actually hold your trade a little bit slightly outside. So what do we have here? Price tapped into that order block, came back up, and then we have that implied fair value gap marked up, and price immediately after this implied fair value gap was marked up, it immediately tapped right into that implied fair value gap. And what you guys could do is set it under this fractal low, or you could have set it even under this order block. It's up to you. And then you could have just went for a strict 1 to 5. And you don't have to be greedy, guys. Like a 1 to 5 is more than enough. And if you wanted to as well, you can also go for a strict 2R. It's up to you. Or you can target a previous area of liquidity, like the high of the previous New York AM session, right? That also could have worked out perfectly fine. So this is just one example of how you can use it. But you guys can use anything else. You can use other fair value gaps, you can use other types of order blocks, you can use other forms of liquidity, other types of imbalances like volume imbalances, things like that, right? So I'm going to give you another example on how you can keep using this type of concept. Okay, so for this example, I'm going to be showing you how you can use implied fair value gaps for analyzing market structure on the higher time frame to get a sort of a bias either for the day or for the week. All right, so as you can see here, and you know what, I'm going to turn on, hold on. Okay, so I turned on my higher time frame candles to show a week's worth of price action. So here you can see we had a bullish implied fair value gap, right? Price was bullish for a little bit, right, for these last 3 weeks. Okay, and then we had that bullish implied fair value gap. But what happened? Price completely broke through, not just with the wicks, with the body, with strong volume, right? Strong volume, and then proceeded to have another big candle. So we had one bearish big candle breaking through that implied fair value gap. That's the first sign. The second sign that confirms this is the fact that we had another big bearish candle going down. And then the third confirmation, which was even more important, was the fact that after price made this breakthrough here, let me mark this up right here, right? So after it broke structure towards the downside, price retraced and did not break past this high, right? It did not create a new set of structure here. Let's see, failed reconstruction, right? Plus, we also have price confirming the reaction here from this rejection block, right? So we have price reacting from this rejection block, right? Confirms the rejection because, well, we didn't have a new high get built, right? So price taps into this rejection block. We also see it break through this implied fair value gap, right, with strong momentum. We see this break of structure towards the downside. And what did price do when it tried going back up? It failed. It failed to even touch the implied fair value gap, making price go down and having some bearish momentum, right? That is one way that you guys can use, or another way that you guys can use implied fair value gaps, even when it comes to having a higher time frame analysis. Now, you don't have to do the analysis the same way I just showed you guys. There's plenty of other ways you could implement this, but these are just small examples that I wanted to show you on how you can use implied fair value gaps. All right, guys, so I need to cover this part of the video. So this is from ICT Executions, February 23, 2023 is short implied fair value gap in action. I'll also leave a link in the description so you guys can watch this as well. This is very important, and it kind of adds on to what I've said before in the past, where trading is very subjective and how ICT has very subjective techniques. So here you can see that price is consolidating between the implied fair value gap, right? You can see it consolidating and it kind of popping a little bit over. Now, I think the reason why he ended up still taking the trade in a bearish direction is because it's a bearish implied fair value gap. Maybe there's a few other things that he's using obviously to confirm this, but it just goes to show that even if price breaks through the implied fair value gap, he still like does his own thing regardless, right? So you guys can take this however you want, it's up to you. But I think the key distinction here is that it's consolidating. So maybe he thought, okay, price is having a hard time breaking completely through the implied fair value gap, so I'm still going to stick with my idea of shorting. So maybe that's why he did it. But like I say, guys, it's very, very subjective, at least when it comes to trading his concepts. You know, he'll say one thing in one video and then say something else in another. So just keep that in mind, because I'm going to show you something different right now. Alright guys, so as you know, I love using the pitch fan, right? So I'm on platinum right now, and I actually set up the pitch fan on my let's see, I was on the 3-month time frame. You guys can copy the settings, pause the video, whatever. So I'm going to go back to the 4-hour, and here I want to show you guys a little something, and this is just another way to confirm the trend, right? As you can see, price reacted off of this bearish implied fair value gap, right? Came down, touched the fan line here. Okay, so we were already previously bullish, right? Price came down, tapped on the fan line, and then what really confirmed it was the implied fair value gap. Now, as we saw earlier with ICT, it seems like as when price doesn't break through the fair value gap or the IFVG with strong enough momentum, he still counts it as valid, at least when he wants to. All right, so in this case, in this particular example, it's up to you. If you want to say, okay, I don't want to use this implied fair value gap as valid anymore, I'm just going to wait for something else, you can do that too, right? What you could do is, for this scenario, you could wait for another one to show up and wait for that one to be respected, like this kind of was, right? It was bullish, it broke a little bit under it, and then we ended up bullish. Now, why is this candle showing like this? I have no idea. I guess it's just the way the broker's sending the information to TradingView, but either way, it held, and as you can see, we're obviously bullish for the rest of the week. Now, if you're someone that says, no, I still count this fair value gap as valid, right? In this next scenario, let's just say I count this fair value gap or implied fair value gap as valid because we didn't have enough strong momentum to the downside. We had a little doji here, so clearly it just swept this liquidity, or this candle's liquidity, and then we had this strong bullish candle. So I think that's more than enough for me to confirm that the trend is indeed going to go back to being bullish. And then plus we have the pitch fan, right? The pitch fan is already set up in an upward direction, meaning that overall price is fundamentally bullish, which aligns with our idea, right? And if you want, you could also look for some swing trade setups, right? As you guys know, I have my swing trading strategy, and just as a sneak peek, I mean, you guys could have had a very obvious setup here, right? 0.75, bam, taps into the 0.75, TP1 right here. Now, if you want to learn more about my swing trading strategy, you guys can just look it up. I'll probably just link it down in the description as well. But yeah, guys, this is very, very simple concept that you guys can use. You can apply it with many other things. All right, and just practice, guys. Practice, open up a chart and try seeing if you can replicate these kinds of things yourself. I appreciate you staying until the end of this video. I really, really do. I always like to leave you guys with some biblical wisdom. This is from Proverbs 21:5. The thoughts of the diligent lead surely to abundance, but all the hasty are only for loss. Guys, if you need help with anything trading, or just even something in your personal life and you just want somebody to talk to, hit me up in the Discord, hit me up in the DMs, do whatever you can to get my attention. I'll try my best to answer you guys. I try to be as active as I can on the Discord, but I have a lot going on right now, so I still try to make time for you guys regardless. And if you guys have any ideas or any videos that you'd like to see, there's also a form in the description below you guys can click on, submit your video ideas or what you would like for me to cover. I have a ton of strategies, guys. If you want a backtesting software, you can also look that in my links. I have a bunch of links to literally everything I use, even the stuff that I'm using to record right now. So you guys can also check that out as well. And yeah, guys, don't forget, join the Discord, like and subscribe, leave your comments down below, and I have a ton of cool things coming up real soon. All right, so stay tuned for that. And yeah, guys, I'll see you all in the next one. Peace.